Develop investment defense strategy. That breathing room we just built isn't just for sleeping better at night. It's actually ammunition for your investment strategy when markets get ugly. While your neighbors panic sell their stocks at rock bottom prices, you could be quietly making the portfolio moves that historically turn market crashes into wealth-building opportunities. The secret isn't predicting exactly when the economy will tank. It's having a defensive playbook ready before the recession sirens start blaring. Let's get real about something uncomfortable. During market downturns, our brains basically turn against us. Studies from behavioral finance show that the average investor underperforms the market by nearly 4% annually, primarily because they make emotional decisions at precisely the wrong times. In 2008 to 2009, investors who sold everything at the bottom locked in 50% losses, while those who maintained their defense strategy recovered completely, and then some. Trying to time the market perfectly resembles catching a falling knife. Impressive in theory, but dangerous in practice. Smart investors focus on something more practical, adjusting their defensive asset allocation based on their personal timeline and goals. Your defensive asset allocation answers one simple question. If the market tanks tomorrow, how much of a hit can I actually afford to take without derailing my financial future? Someone retiring next year might answer, not much, while someone in their 20s could potentially weather significant volatility. Think of your defensive portfolio as a castle with well-guarded ramparts. The outer walls protect your immediate needs, while the inner fortress secures your long-term wealth. This translates into a 3-bucket approach. Bucket 1 holds money needed within 2 years in cash equivalents and short-term bonds. Bucket 2 contains money needed in 3 to 7 years in a balanced mix of bonds and defensive stocks. Bucket 3 houses money for 8+ years in growth-oriented investments. This approach prevents the devastating mistake of selling growth assets at their lowest to cover short-term needs. During past recessions, investors with this structure avoided the fate of one client who lost 40% of her retirement because her house down payment was in aggressive stocks when the market crashed. Certain asset classes historically perform better during economic turbulence. Consumer staples, companies making products people buy even when broke, typically outperform during recessions. In the 2008 crash, while the S&P 500 dropped over 50%, consumer staples fell only about 28%. Utilities, healthcare, and discount retailers often provide similar protection. Quality dividend stocks with strong balance sheets and low debt also provide cushion during market turmoil. During the 2000 to 2002 bear market, high-quality dividend payers outperformed non-dividend stocks by nearly 15%. Defense also means keeping powder dry. Having 5 to 15% of your long-term portfolio in cash serves 2 crucial purposes during downturns. It prevents selling depreciated assets for expenses and provides capital to buy quality investments at fire sale prices. Many of today's fortunes were built by those with available cash during the 2008 to 2009 crisis. Strategic rebalancing serves as a powerful, yet often ignored defensive tool. This set-and-forget strategy automatically guides you to sell what's gone up and buy what's gone down, aligning with your target allocation without requiring market predictions. For example, with a target of 60% stocks and 40% bonds, if stocks tank and shift your allocation to 50-50, rebalancing means selling some bonds to buy more stocks, exactly when they're on sale. One investor who maintained quarterly rebalancing during the 2008 to 2009 crash ended up with 31% more wealth 5 years later, compared to those who made no changes. To test your portfolio's recession readiness, run it through a stress test. Free tools like Portfolio Visualizer show how your investments would have performed during previous market crashes. One investor discovered through stress testing that his diversified portfolio had 80% in technology. Stocks, a simulation of the 2000 to 2002 tech crash, showed he would have lost 72% of his value. This exercise identified and fixed a massive vulnerability before the next downturn. Investment defense isn't about avoiding all losses. It's ensuring temporary losses don't become permanent by forcing ill-timed sales. Even Warren Buffett's Berkshire Hathaway has lost over 50% multiple times, but solid defensive positioning kept those drawdowns temporary while long-term gains became permanent. The cornerstone of your defense strategy is psychological preparation. Before market drops, document your response plan. If my portfolio drops 20%, I will rebalance according to my target allocation. This pre-commitment makes you 60% less likely to panic sell during downturns, according to research. When CNN runs market meltdown graphics and your 401k shrinks, this written plan becomes your emotional anchor.